Welcome to another Grey Market Talk with Thorsten, the former market maker, now retired, and Nic, still very, very, very busy, portfolio manager and chief investment officer extraordinaire and officer. It's early in the morning. I have a chest right in front of my building. I'm living in a little village, and it's quite famous for a jazz festival. So they're piping this noise into my head every day. And Nic and I met this morning. I'm exaggerating now at 4 o'clock to record that. So you might forgive me. Chief Investment Officer with quadrillions assets under management. And we have a couple of topics today. Obviously, it was, well, can we call it a slow news day last week? We had fantastic employment figures, which, well, came in like a bomb. Nobody expected that happening. Then we had the 4th of July. Okay. Then we had Coke in the White House. Very, very interesting. Have you followed that news, Nic?
Vaguely. Only everyone's denying who was in the White House at the time that the Coke was found. Or
well, if you follow all the conspiracy theories like I do on YouTube, it's very interesting. I had a recent video of the Biden family, and then obviously they took a picture straight away when Hunter Biden was.
All roads lead to Hunter.
bless his heart, really. If honestly, I'm not offended, but if this guy has overcome an addiction and they're still banging on about it, the White House is a public place. Everybody could be running around doing all sorts of stuff. But yeah, well, that's one of the topics that stuck in my head. And employment figures, we might get into it in our discussion that's following. It might be a bit further away. There is a meeting in August, and I'm sharing my screen now with a picture. You can see it, Nic?
I can indeed.
Yeah. Which actually made me curious, yeah? Because I think that could become a big topic if it's done properly. And BRICS planning, for everybody who's just listening, to introduce new trading currency backed by gold at August in Summit. BRICS plans to introduce new trading currency backed by gold. Big question mark behind this, because I'm a gold buck. I like gold, and Milton Friedman would jump into my face for liking gold, and I admire Milton Friedman as well. But looking at the situation we have at the moment, I always make that, as viewers have seen, I tend to smoke the occasional cigarette. And I was sent by my father to buy cigarettes for him a long time ago to one of these machines we used to have. And 20 cigarettes at the time did cost 2 Deutschmarks, which is below €1, actually. Yeah? And yes, I'm old, but not that old. So it's one of the huge inflation measures we can see here. And gold obviously has a topic, as a lot of people call it, real money. Nic, you're an economist, you know how markets work, especially the role of gold. Is gold real money, or are there other forms of real money? And if it is not, or if it is real money, what should we think about this attempt here of a meeting in August, which might announce something amazing, or something which, well, could be just another attempt to introduce something nobody wants?
Okay, firstly, let me correct you. I'm not an economist, thank God. We touched on this topic briefly about the necessity of the highly indebted countries, these large economies, the US, China, Japan, Europe, the necessity of these guys to keep printing, because at the end of the day, the growth of their debt is much higher than the growth of the income, if you like. So the tax that they get is not enough to offset the borrowing every year, and so for that reason, the debt continues to grow. And if the debt continues to grow at a much faster rate than anyone can actually continue to lend to support that debt, the money has to come from somewhere. Well, the money's not there, so the only way that they can deal with this thing is if they print their own stuff. So whilst there's a game going on about, the dollar versus the yen versus the yuan versus the euro, whilst we're all focused on these inter-market crosses, what's really going on in the background is, I can't remember, was it Margaret Thatcher who said, the value, no, it was Harold Wilson, the value of a pound in your pocket. It's not what it used to be. And at the end of the day, your currency, the thing that you've got stashed away or not stashed away, is losing its value. And because it's losing its value, you have to think about certain asset classes you look at to protect against the devaluation of the underlying currency. And gold is one of them. Bitcoin might be another one. Your home might be another one. And those are the kind of long-term things that you need to think about, to protect what is going on and what is clearly going to continue to go on. Ignore what the central banks say. They will continue to print. They have no other option. Nobody's going to buy their stuff other than themselves. And so, the US will continue to have quantitative easing. And it's not me who says that, it's the US themselves. So if you go to the Congressional Budget Office, they've got their forecast of QE continuing beyond the QT.
Well, what we have here is it's clearly a political game, right? Without any doubt.
Yeah.
Why the dollar? I don't know who said it. It's our currency, but your problem. And I think for the first time, somebody thinks seriously about, well, let's get rid of that problem we might have. And for me, the big mistake the United States made, taking the Russians out of SWIFT, telling them, yes, you used to have treasuries in the past, but we can tell you, you're not good here anymore. Yeah, you can't buy stuff with that. Will give an idea to the Chinese, to the Indians, to pretty much everybody out there. If I'm not conforming with the wishes of the United States, they might take my savings away from me, which is a very, very bad thing. So we have a political situation here of economies which are, without any doubt, up and coming, right? No doubt about that. And they want to back it with gold. Everybody likes a bit of gold, and we've seen over the last, 24 months, huge central bank buying in gold. Would this thing have legs?
So I apologize for sort of going around the houses and beginning with what's going on in the States and why, you need to think about protecting your wealth. It's really important when you start to think of it from the perspective of oil producers. So oil producers, they get dollars. What do they do with their dollars? So historically they say, okay, let's go and buy some treasuries. Yeah. But the growth of the supply of treasuries, as we know, is somewhere between 8 to 10% a year. So the supply of the thing they're buying is just continue to expand and expand and expand. And these oil producers are really worried about actually the stability of the dollar with, what they stick their oil revenues with. So the resources of their country are going into something where the supply seems to be endlessly increasing. So in the meantime, they get a nice 3 or 4 or 5% coupon these days, before much less. So I think, the discussion began many years ago. It wasn't, the Russian the freezing of the Russian cash. This discussion went on a long time ago from oil producers to say, well, what else? What is stable versus oil? And, the ratio of oil to gold has been, fairly stable over time, whereas the ratio of dollar to oil has not been stable. And that just shows, whilst the oil price has been going up, effectively what that's saying is the dollar, the value of the thing that they're going to put their money in, at the end of the day is actually declining. So these discussions and thoughts have gone on a long time ago. The Russians began, their own thought process, and then they wanted to introduce their own currency amongst the Russian region and the stands and all of this stuff, and so they have actually sort of been working on something to have their own trading currency. And of course, the whole thing has been accelerated by the freezing of the Russian reserves. But it's not just that. It's not just for the point of, what do I do with my oil money? The African economies want to have, you hear these discussions. The African economies want to have their own say. They don't want to be dictated to by the larger powers. They don't want to be dictated to by France, by the West, by the IMF, by whatever. So they want to have much more control. And I think what they're saying is, and this is just, classic decision thing, is the system we've got now good for us? No. Well, therefore the other system must be a lot better, because it can't be worse than what we've got now. So there's a kind of a natural magnet, if you like, when a group of countries get together and say, look, we're looking to build something to challenge the Western system. Do you want in? And actually, an awful lot of countries want in. So you are, I can't remember the last count, but 27 large economies, which probably account for about 2/3 of global GDP, want to be part of this system. Now, whether and how you actually, we know about 27 countries who want their own kind of currency. It's the EU, and what a cock up that is, frankly, in terms of how they make decisions and stuff. So actually finding a mechanism which will work for everybody is not something that's going to be announced on the 22nd, I think it is, of August, but rather, they may well start to talk about something which say, we're going to take the first steps to this thing. And that will be a wake-up call, I think, for those people who believe that the dollar is the king forever. It's certainly king, but it will lose its, how should we say, the strength that it's got now over time. That's clear.
Interesting point you just said that they had enough. Let's use colloquial English here. They had enough of being dominated by the United States. So what then? So you actually want to find new bedfellows like China and Russia to get something up. On the one side, you have a democracy, with all its flaws and its positive sides, but it's a democracy and it's a free country. And yes, they have a bit overboarding political ambitions worldwide, let's put it that way. But so does China, and so does Russia. But they just didn't have the opportunity to actually do what the Americans did for the last century. So when you have all these countries producing stuff and being afraid of the dollar domination and having the political angle to say, oh yeah, the Americans tell us all the time what to do and dominate us. So the alternative is China and Russia? I don't get that in my head.
So, we must not forget that you and I are not necessarily privy to all of the things that really go on between these economies and some of the Western economies. And whilst I'm not, I'm certainly not the expert on what the Africans are doing and how the French are involved. They have this French currency, which seems to, be very pro-France and very not pro the economies of Africa. These guys, they clearly say, actually, we understand these guys, the West has democracy and has all of this stuff, but nevertheless, I'm telling you, because we see it on the inside, it's not good for us. And if it's not good for us, we'll have a look somewhere else. And I think that's really what's going on right now. And as I say, if you give people the chance to vote at a time where they're disconcerted about what's going on today, they'll say, well, we'll go for the other option. What is the other option? Oh, right. The other option is China, Russia. Yeah, we'll go for that. Hey, it's not implausible, frankly, and so even where I sit, it's quite exciting to see real competition in the world rather than one dominant player. So this could be good.
I've just clicked up another slide, and I apologize sincerely. These are all my clippings during the week where I do a screenshot on the photo. So I would like to give credit to all the guys on LinkedIn or who send out emails that I'm using their slides here. I can't. I'll try to fix that at one point. So everybody who is watching or viewing this and I've used their slides, their public domain, I would love to credit you, but shortness of time, I'm a bit lazy. I haven't done that yet. What you see in front of here now is actually a forecast, what could be the most important economies in the future. And it's a longer term chart. You see the past starting in 1980 and it goes up to 2075. And obviously it seems in the forecasting ability simply a progression of the past growth rates written into the future. And what I found interesting as a German is we started at place 3 in 1980, held that up to the 2000s. Now we are on 22 here on this chart. Germany's gone to place 4. I'm pretty sure we will decline even further. That's what the forecasts here give as well into 2050. But what we can see here on the long run is China and India as number 1 and number 2 economies, US still number 3. And then we have a big block, the block you just mentioned, Indonesia, Nigeria, Pakistan, and Egypt. Do you think this is realistic, what we see in front of us, Nic? Is that the future we see in our world economy of new and emergent economies who will dominate the world market, not only monetary, but then also politically?
So I don't know about politically, but I mean, money is power. So that could well be the case. You see the US is still up there, and it doesn't lose its dominance. It's not number 1, but they're still up there. Whether the names hold the power, without being rude to Egypt and Pakistan, you would wonder, but you'd think as a group, certainly it's quite possible when you actually put these people together, and they are the BRICS. The people who want to join the BRICS. You've got Brazil there, and Nigeria and India, and these people together will be a very, very powerful force. And if you look at the top 10, so you've got US, but let's have a look at where is Europe in all of this thing. So you've got France and Germany, and then you go to 2075. I mean, will I still be here? No bloody chance, sadly. But those two are sort of only just keeping their claws into the top 10, or top 15, in fact, that is. It's the world will shift its power to the from the west to the east. I think that is a given, and I think this whole BRICS thing is their way of saying, well, we want to have a much bigger say than what we have had so far, and this is our way of doing it, because we don't trust you to be honest and fair and without dominating and telling us what to do. So good luck to them.
Yeah, no, I deliberately put this chart in front of us now because there's something else I stumbled across, and I found that very interesting. The progression to become an economic powerhouse always is related to the whole population, about the education level. And that was a clipping from The Economist, which was very, very interesting. It actually shows you the female literacy rate after 5 years of schooling. And we have these emergent economies in front of us. If you can't see it, Vietnam is doing fantastically well on the educational side. Indonesia is also right up there. Peru, South America, Central America also seems to go in the right progression. And then you have, well, Bangladesh, I would call them in the middle field, but the big ones we just mentioned, India and Nigeria, look just terrible. You have these economies One is a huge population country, Nigeria as well for that purpose. Nigeria has all the resources, but half of their population seems to become less educated. And we still have these forecasts that there will be the up-and-comers in the future. That, in my head, actually did not get together. I found that actually quite threatening to look at this chart and think, wait a second, you have this up-and-coming country like India and Nigeria, but their female population does not get the education you would expect of a progressing country?
Yeah, I mean, obviously, you know, if you hadn't seen this chart, then you'd be saying, well, hang on a minute, surely India would be really up there, because everyone talks about India having the you know, very educated population, and the chart doesn't make sense in that respect. But if that's true, then that's true. You know, what does it mean? It means these economies still have a lot of work to do, and you know, if they want to be part of the you know, the big players, then you know, there's a business opportunity for you to help that. But no, it is surprising, I must say, very surprising.
Yeah, it got me as well. There's another chart I put up, especially when we're talking about the emergent economies. That was a correlation analysis, which I also found interesting. Emerging markets and frontier markets against each other mapped. Green means almost no correlation. Red means extremely high correlation in there. If you watch this on YouTube, zoom in and do a screenshot, because I thought it was very interesting, especially when we look at countries which are a bit on the red side here. Yeah? Like Poland, like South Africa. South Africa was also one of the topics. I have a good friend sitting in South Africa in Johannesburg, and I chat with him recently, and things are not looking really good over there. Let's put it mildly. Yeah? They used to be nuclear power, didn't they, Nic?
You are much more.
I think before apartheid, they deliberately staved away from their nuclear capabilities, passed that on. And no, the topic we had is we were on Zoom and he broke down, and we had to have a meeting a little bit later. And he said, oh yeah, it was load shedding. I said, what do you mean load shedding? I've heard about that in the news. I said, no, it's a thing. My generator didn't work. Probably didn't kick in straight away. So I'm now without power. So that isn't the new thing. What is a new thing now, they seem to get problems with water supply as well, where they actually pinch the hose. Yeah, you can't have fresh water or clean fresh water whenever you like it. And that's when I thought, okay, where do you see the correlation in here? And one of the things, I had Singapore, yeah, as one of the tigers, and in South Africa, and you have here still a very high correlation. And I like things I don't understand straight away, because it didn't make any sense. On the one side, you hear something like South Africa is clearly not doing well. On the other side, you hear from the original tiger, Singapore, is doing quite well. How is there such a high correlation between these two different, I don't want to call it economic systems. They're both capitalist, more or less, yeah, with all the caveats that come with it. But if I would have to set up an international portfolio, Singapore is a top candidate to be in there. South Africa, clearly not. But the charts are telling me, oh, they, at least in the past, used to have a extremely high correlation. Could that fade away, or am I getting it completely wrong, Nic?
You know, this is big question mark. No idea. Frankly, I have to put my head to that correlation factor. Yeah. But I mean, you know, coming back to this topic of you know, the African states, it just goes to show you that there's still room for a huge amount of investment there, and that's really important. There can be those economies that still need basic infrastructure and basic investment. I mean, actually, the West needs some basic infrastructure updates, but you know, Africa has the resources. They, in theory, have the money. You know, they're going to need to spend an awful lot of money to get themselves up the curve if they really want to be, you know, a powerhouse in the world in the next 30, 40, 50 years. They will have to spend some money.
Yeah, So if these powerhouses actually would join the planned super duper currency gold-backed, one of the things that crossed my mind, I thought, would I ever prefer US dollar or this new shiny gold-backed thing? And I thought, what would actually made me accept the thing that actually would deliver gold? The one point is, could I trust the guy who actually would deliver gold for their paper currency when I want some? And obviously, I like to think how you could get things going. I would establish a bank in Switzerland, which is doing the settlement procedure independently, telling you, yes, whenever you want to exchange your paper money into gold, this Swiss institution, working completely independent as a settlement facility, will provide you with the gold, because it's very unlikely that China will invade Switzerland or Russia or whoever. Then I think we would have a real potential winner at the start. Conspiracy, Nic, or is that something which could boost this thing into the stratosphere?
In 5 weeks' time, we're going to find out the first steps of what these guys are going to do. And as I say, this is the very first step of something quite major. And you can see, it's kind of sensible, because today, what central bank says, okay, instead of accepting dollars and putting it in treasuries, I'll accept the renminbi as part of my portfolio, and that's just such a long shot, and it may be temporary. So what they've managed to do is to say, okay, well, we get 27 people together, and part of our plan is they will accept the renminbi. And, these are really the very, very first steps. And once you start to get that acceptance, well, then things like the story that you've just talked about with a Swiss bank and exchanging, is quite feasible, because they're going to have to make it internationally convertible and so on, rather than just something located in Shanghai or the like. So, as I say, very first steps. There's a big project. Kind of makes a lot of sense for these countries. Exciting. Frightening, but exciting.
It's if you read the history books, when Germany had its hyperinflation after the Weimar Republic, Hjalmar Schacht, he was the head of the Reichsbank at this time. He saved the country by introducing the so-called Rentenmark. The Rentenmark was the proper currency that came after the Weimar Republic had its hyperinflation, and it was backed until the currency established itself again by making it, obviously oversimplifying it, pretty much by farmland. And people suddenly started trusting that, by an asset-backed security in the real, or an asset-backed currency in the real meaning of the word. It is an interesting topic, especially with a long-running dollar weakness over the last century. America was growing fantastically while they didn't have fiat currency, while they were trading just in gold. It's also one of the things Milton Friedman didn't like, because it didn't fit his theory. It was always the argument then, yeah, but to get more growth, you would have to dig more gold on the ground to slush it into the system. But on longer time scales, you've lost a lot of your purchasing power if you were just held on dollars the moment they were introduced as paper money. So it is clearly a very, very interesting thing developing there. And what I'm looking into is the detail I just mentioned. How are they going to make the settlement procedure? If you back something with gold, you want to make sure that you actually can get your gold if you want it. If they get that right, they have a real competition out there. I believe that, especially with the points you mentioned earlier, with the political shenanigans going on, that they don't like the influence so far put all over them by the United States.
The bottom line is, exactly the point that you say. Historically, when the currency was backed by gold, you didn't have that flexibility, and what if you needed more? And by definition, if you have Bitcoin, you don't have that flexibility either. And having something backed by gold effectively says, we are not going to be like the West. We are not going to just print and print and print and spend and print and so on and so forth. And, we're going to be disciplined. Gold, gold supply is 2% a year. Well, roughly. What is the wish from the central bankers of the West? The wish of the central bankers of the West is that they say, well, we will accept a 2% inflation a year. Well, if you are going to accept a 2% inflation a year, then back your currency by gold, because that's inflating by 2% a year. And if that's really what you want, and it's clearly not what they really want, because they want this flexibility. They want to create a credibility of their currency. But in the end, the reality is they will have to continue to print. And I think, these economies, which, as I said to you, they all need investment. Well, when you really need investment, then, is that the time where you want to sort of lock yourself in to linking your currency to gold? So, this will be relevant for a few countries at the beginning and phase in later for those countries who still need to spend money.
I was just about to get into your original thesis, because you mentioned it. We talked about that many, many times. And you correct me if I get it wrong. Things will not be that bad because they're simply not allowed to get bad.
Correct.
Correct. And when if let's put a big if in front of it, if we get an alternative to the US dollar, we are clearly getting into a territory where your original thesis might get destroyed by market forces. I have another slide on here, which I found very interesting, because that is actually the segue to the credit markets. It's US high yields, investment grade yields, are now yielding the same as cash in the United States. And on the next slide, we see actually bankruptcies are rising despite steady credit spreads. That's one of the things I do not understand, and give me a little bit of headache at the moment. We also strived this topic before. You see companies going bankrupt because financing costs are getting now prohibitively expensive. The credit wall is rolling in by the end of 23, 24, when a lot of the companies have to, churn their debt into the next segment, and prices where they could finance themselves below 1%. Let's be even pessimistic here. When they originally made up this debt, is now yielding 5.5%, 6%. How does that come together with our current economic situation? Labor markets seem to be absolutely fantastic. We started the conversation today with that. Companies are defaulting at a higher rate or declare bankruptcy at a higher rate. And the credit market says, yeah, we'll be fine. Well,
great question. So let's go back to your first chart, which was
investment grade
versus forward, if you like. So one is your US T-bill, so let's just say it's 3 months, versus what's the IG bond index? It's got an average duration of 8 years, 7 years, 8 years probably. Given that we've got an inverted curve, because the term premium is hugely negative, then obviously there comes a point where you do play catch up, and you say, okay, so what should I be doing? Where do I think interest rates are going to go in the future? If you think interest rates are going to go down in the future, and you buy T-bills, well, then, you have this sort of rollover reinvestment problem each time. If you think interest rates are going to continue to go up, well, then, you want to be at the short end of the curve. So, it explains a state of, you could have shown me this chart effectively 2 years versus 30 years, or sort of, it's the same thing at the end of the day is, 1.0, why would I buy 30 years at below sort of where the 2 years are? Yeah, I mean, clearly. But the curve went to minus 100 and it's now steepening last week. So, this chart, state of affairs, that's where we are. And then the obvious question, if someone brought this in, I'd say, okay, so what? So what's the trade? What do you want to say to me? And I don't know. If I brought in this chart and said, "Hey, boss, look at this," and you'd say, "Well, fascinating, but what am I supposed to do? Am I supposed to buy T-bills now? But what's the implication if I buy T-bills and sell my IG cash, big question mark. So you can have a look at, I know one of your slides later, you showed the total returns for 2022 versus 2023. You'll see that even leverage loans last year made 11%. So you would have been wrong to kind of, sort of focus on, I've got to be in T-bill rather than in something else when there is another opportunity. I think the two instruments here are totally different, and depending on our outlook, one may still provide value versus the other. And as I say today, I'm not sure where I'd be. I don't like bonds in principle. Yeah, I mean, because I believe in yield curve control, and therefore on that basis, I wouldn't buy anything long dated. But and the second chart you showed, which was about bankruptcies, we talked about this very, very briefly last week, where you said, yeah, that's the one slide 4. I said, hey, you know what? What has happened in the last few years? In the last few years, you've had interest rates at 0, negative, everything else. You've had every central banker saying lower for longer, don't worry about it. We're unlikely to increase interest rates. So they effectively said to the world, please go and lever yourself up. Okay. So the private equity, they love that. So all these private equity guys, they go in there, they go and buy these companies with stable income streams. They lever themselves up 4 or 5 times. They say, thank you very large. And then suddenly the Fed say, oops, we printed a bit too much money. Actually, I don't say that. They say somebody caused inflation, and so we're going to have to tighten now. And so sorry about that. And of course, all of these levered companies, I mean, their own fault. All of these levered companies are going to get absolutely frigging mullered, and even companies that you would not expect. So you probably heard the name Thames Water. Is the sort of water utility company in the UK, around the Greater London area. Of course, these water companies have to spend a lot of money cleaning up sewers, building new sewers, fixing their leaks. So they have a lot of capital expenditure. But you had private equity went and buy this thing, stable revenue, lever this thing right up. They have about 15 billion of debt. And now the investors say, well, we're not going to sort of plug the hole, sort of stop the leak. And potentially a company like Thames Water is going under because of it's the same thing as the discussion we had about the pension funds. Yeah. If interest rates were clearly visible that, well, we're on a slow and steady path, people can handle it. I mean, when I had a mortgage in 1985, my mortgage rate went to 14.5%, right? I was levered up more than 3.5 times my income at the time. It's fine. If you know what interest rates are, you can plan. But if you have been told that, don't lower for longer, so you say, okay, let's just say in my model, I say, okay, interest rates go up by 2% in the lifetime of my loan. Sure, that'd be fine. Yeah, 2% easy. 5%, you're murdered. You're dead. And these companies who have been listening to the central bankers literally and levered themselves up are getting absolutely hosed. And well done, central bankers, is all I can say, because you've been responsible for this. In my view,
isn't that amazing, Nick? That everybody who was prudent and was following what the leaders are not thinking about, are now getting completely screwed on the investment they've taken on Thames Water. That was actually very interesting. I watched the program on British television last week. And I said, okay, the regulators would have allowed, I think it was privatized under Maggie Thatcher, would have allowed the private investors to have an annual return around 8-ish%. So what they did actually, they levered the whole company up that they ended up with return on equities of almost 40%. They took everything out they could out of this venue, and now they are exactly in the situation you just described. They don't want to cough up the money to make the repairs, and we already have hosepipe bans again in England, and it hasn't even been a particularly hot summer yet. that is a bit of well, not a conundrum. You see what's going on there, and I'm totally with you, because that's another slide I brought up right in front of us. If you have done what the central banks have told you, you're a bit underwater at the moment, and that is one of the things that keeps up popping in the news all the time, and it actually goes quite in nicely with our talk about liquidity, the plumbing of the system. This is pretty much just in yellow here at this spot is the Bank of America Corporation, and that's their govie bonds they have in a portfolio, and they're down 108 billion by now after this massive increase. Is that a reason for concern, Nic? Maybe you can explain again why it isn't, or if I've got you completely wrong, and hey, let's put on a nice short.
Well, you know, I have to put the 108 billion into context somewhere, and that means, you know, you have to do your analysis. I'm afraid this slide is a starting point rather than the end point of your analysis. So, you know, it may well highlight some things, and you might get, you know, be more excited about the Northern Trust Company at 2 billion than the Bank of America at 100 billion, because at the end of the day, you know, your treasuries are going to be paid back at par, and therefore, who can last the longest? And
at the just to get that right, at the meantime, they could hand this collateral back to the Federal Reserve at a 100. So it's not really.
It's expensive though. Yeah. You know, it's not cheap, right? And it does show some not very careful management of their portfolio. You know, that's a management problem. That's a sort of risk management problem, and all of this stuff. But at the end of the day, you know, what you don't have on this chart, which is for me much more significant, is, you know, what is hyperinflation? Hyperinflation is I lose confidence. Yeah, I lose confidence in my currency. So who belongs on this chart? Who is not on this chart? The Fed, the ECB, you know, the Bundesbank, you know, all of these guys. How much money are they losing?
Well, I don't have a chart for that, but there's also, because you just mentioned them, if you by general agreed accounting standards, the Fed is bankrupt, the ECB is bankrupt, the Bank of Japan is bankrupt. The only guys who did it quite cleverly, I found interesting, is the Bank of England, because with all the Corona money, the Bank of England actually managed to get an IOU from the government.
Yes, absolutely. Very clever.
For the amount being paid out.
A rare stroke of brilliance from the Bank of England. You know, one tick they get. Absolutely right. So the Bank of England, I think wasn't the Corona stuff. I think it was under the former Governor Mervyn King, who basically, when
yes, of course,
he structured the, you know, things at the Bank of England, he basically said, oh, by the way, if we ever lose money, you will cough up when he got somebody to sign that. I can't remember, Gordon Brown. Oh, I can't remember who it was, but you know, they signed up. So the government is fully government backed, right? Whereas every other central bank is toast, right? But they're not toast because they can continue to print. And you say, well, okay, well, look, what if somebody says, I don't buy this stuff anymore? Well, that's when you get this sort of hyperinflation problem. So, you know, you rightly show me a chart of Bank of America, and I'd say Fed, you know, Bank of ECB. So how big are these numbers, and what does it mean politically when, you know, the Fed have to go to the you know, the government and say, by the way, you need to put money in, and they say, well, hang on a minute, what do you mean? Well, if we put money into something, surely we want to control it. And then you lose this whole independence thing, and then, you know, it's where the confidence suddenly gets lost, and so on and so forth. And in Europe, it's exactly the same thing. You know, I'd love to hear the discussions of the ECB saying, you know, we've lost an awful lot of money, and can you cough up? How do you do that?
Well, it's getting even worse, because the ECB is owned by the national central banks. Bundesbank, obviously one of the biggest central banks, so they would have to make up for the shortfall. The Bundesbank itself is obviously bankrupt by normal standards, accounting standards, and the Bundesbank would then have to be recapitalized by the government. That would be a very interesting discussion in German parliament at the moment. If we would say, the Bundesbank would say, first of all, we are broke, but we need more money because the ECB is broke. And then there is this ominous target 2, which people are talking about for 10 years now, which is actually money sloshing within Europe, but without actually giving any securities for it, which is now at the level of 1.2, 1.3 trillion or something.
It's a big number.
Yeah. It's a very big number. No, on this chart, I found actually interesting. You mentioned the relative relation. Total securities you have here 824 billion, and you have a potential loss at the Bank of America of over 10%. And then you have here Monster JP, who took out good old Bear Stearns at the time because they had their balance sheet fortress with only 5% underwater. What goes through my head, you also mentioned management is the idea. Yes, you know, you're not going to get bankrupt. You can always have the Fed and you ping that stuff over at par value. But what does that mean internally? You know, you're underwater. And things are not really working out for you. Are you then expanding your credit business to get the economy going, or are you also tightening the standards while you already have sharply increasing interest rates? Could that be, and that is my last chart for the economic thing, could that eventually deliver the trigger? Because what we're seeing at the moment, I have a surprise index now by Citi, US Economic Surprise Index. The market tends, or the data that comes out seems to be exactly the opposite of what reasonable people forecast what would happen. So at one point in time, there will be the catalyst coming in that brings that whole rotten FSC down, in my point of view. I don't know what this catalyst will be and when it comes in, but there are so many different data points pointing in different directions. You know what, in this conversation we had when we talked about their long-term security has been there. I'm itching to buy long-term bonds in the United States. The moment I see that the curve starts steepening, I would love to trigger that, go long duration and make a fucking killing, in the market. It's not there yet. I know that. I'm with you on that. But it's really this, for God's sake, it's about time that we could put on this trade.
Sure. I mean, you know, the point you're mentioning now, right? Okay, firstly, surprise index. So what does that tell you? Don't be surprised that Wall Street was absolutely frigging wrong. Okay. And it's not the first time. I mean, Wall Street is awful. And all of these guys who sell subscriptions are also just, you know, following Wall Street analysts. And sadly, they have been horribly, horribly wrong. So, you know, we've been talking about how the economy is not really firing. The economy is not firing on all cylinders. And now we've got the biggest surprise ever for an economy, which is, well, it's okay. It's, you know, this is not a monster. This is not a rocket. You know, this kind of growth level is, you know, is still below trend. And yet we have the biggest surprise. So we have the biggest surprise because the people who are paid the most money keep getting it wrong.
Nic, you're an expert on liquidity. I came across this chart. I don't know.
Beautiful chart.
Global net liquidity in relation to the S&P 500.
Well, very good.
Obviously, you can always pull different.
It's probably about right. I mean, I'm not going to. Well, is it really? Okay. So, what's going on? So last week, actually more than last week, it's been for a few weeks. I don't know. I'm sure I mentioned that liquidity, you know, is a bit is flattening off. That, you know, the market is a bit stretched. The elastic band is, you know, is kind of getting stretched a little bit. And here you can see how much of a stretch there is between global liquidity and S&P. Let's assume the number is right. Yeah. Well, what actually happened last week, on top of everything, you had kind of, you know, everything, you know, the perfect storm, as it were. So you've got this TGA, reverse repo, switching that has, and QT at the same time, which has actually still seen more of a drain than, you know, adding of liquidity. So number one. Number two, you had the Chinese who basically up until now, because I mean, China is in a deflation. China is in quad 4, right? Clear. And for a long time in quad 4. And in quad 4, what you need to do is you need to add liquidity. You need to sort of encourage, you need to support the assets which are collapsing, and they are still collapsing. It does take time. I mean, you know, from the experiences that we had in the global great financial crisis, it took a while before things found a bottom. Yeah. And what's going on in China is they have been pumping liquidity, definitely not enough. And then last week they said, we're going to stop that. And suddenly, instead of putting more liquidity, there's effectively they've stopped. So you've got the liquidity pumper. You know, 1 week before they put about 1 trillion yuan into the market. This week, stop. And they did that to support their currency. So they're really worried about the currency. And here's the big sort of thing, you know, protect the currency. Or effectively protect your economy and your bond market. And that's a big question mark, how these guys behave. So you've had the US thing, you had the Chinese thing, you had oil a little bit higher during the week. So these are all kind of liquidity drainage issues, if you like. When oil goes up, that's also not good. What happened last week, which is, you know, I won't say strange, but and on top of that, you had the value of collateral fall because yields in the US actually rose last week after these job report change, whatever it was, yields went up. Okay, the liquidity drain. When you see a drain in liquidity, what is the first thing you expect to see that goes up? It's the dollar, right? I know you're going to say that. So there's the dollar, and the dollar went down. The dollar went down, and a fascinating turn of events. I mean, you know, I'm dollar bearish, so I expect the dollar to go down. But as a result of a liquidity drain, as a result of this chart, as a result of what the Chinese are not doing anymore to protect their own currency, the dollar didn't go up. And for me, that's it tells you that whatever is going on, they will continue to have to print. That's my interpretation of this thing. You know, they will have to print. And the net result of that is you see term premium actually lower than what it was. And actually, you did see that. You saw yield slightly higher in the 10-year, almost in dangerous territory, because the other great thing that happened last week that should scare the pants off people is the move index went up by about 20%.
Yep.
Very, very, you know, all of these things, China, the move index, you know, the TGA, whatever it is. So all of this stuff going against you, and the dollar goes down.
This is one of the things that made me, well, let's put it that way, put a little bit on my radar. We all remember, especially, well, those of us who are a little bit older, the correlation 1 event, when everything goes in the same direction. And that, what you just mentioned, I had the feeling a little bit last week. Equity's a bit weaker, bonds weaker, dollar weaker, gold's not really doing anything. You know, what we have seen, and I don't want to say the bad word, in 2008, people start talking about credit again. Economic surprise index, liquidity will have to be provided to the market eventually to save it. And I found this slide actually very interesting. Somebody made the work and went through the interest rates from 1310. I don't know how they get that data up to 2018. The best investments I always made in my whole life was when long-term charts, and I'm not a chartist, but when long-term charts got broken. When Gordon Brown sold gold, I loaded up like crazy because this long-term chart was petering out to the side, and then the final signal came. So if this liquidity needs to be provided eventually when the big Armageddon comes, and I think we are in for a severe global recession. I can't tell you when exactly, but it's going to happen. And then they have to provide liquidity. You have here an extreme long-term charts going back from the 1300s, which if we have this huge increase in yield, would clearly require a complete redrafting of the world currency systems we have, because then something is really, really broken. Then it won't cut the mustard anymore.
Yeah, I mean, you know, I wouldn't necessarily go so far today. What everything shows you, everything we talk about is, you know, there's clearly the financial system is not stable, it's highly fragile, and it needs constant care. It is a patient that needs constant care. And in the meantime, we have to navigate and stay on the road, right? We have to slow down at certain times. We have to turn left at certain times. We have to go, you know, uphill at certain times. We have to slam the brakes on certain times. But we have to keep ourselves on the road and our clients on the road. But in the meantime, there's this maelstrom of bloody economic and financial and liquidity and it's hell over there. And we have to kind of get some sense about what we need to do and when we need to do it. And, you know, up until now, you know, my message to my clients has been, you stay long, you stay in credit, you stay in equities, you know, there you are meant to go against this trend. And, you know, we're reaching the level where, you know, people can afford to take some stuff off the table. So my charts on the S&P for the last couple of weeks, I've been saying, okay, look for a retracement on the S&P. You know, nothing big, it can be bought, it's only a retracement, because at the end of the day, they have to keep the patient alive because they are not prepared. I really don't believe they're ready for a major upheaval in the financial system. You know, the best they're going to come up with is a digital currency. I mean, you know, what is that it?
Well, it was a bit facetious. That's why I put this extremely long-term chart on here. But you already mentioned the S&P. What I did with my straddle, I was very happy with. Volatility increased, even on the equity side, tiny little bit. And I scalped my gamma for the first time.
Very good.
So I'm getting closer now, inching in on to my house money approach, where I will eventually end up with having cost nothing. And why did I do that also? We are still in the region of extreme greed. We have recovered a little bit. It was higher. We're now at a 78 level. And then I saw this beautiful chart, which obviously bias confirmation, what I wanted to see. I don't know how they come up with these things, but what you see in front of you, you see the S&P and you see the smart money and you see the dumb money with their exposure. It's one of these conversations I always had with my students. They said, oh, Thorsten, you were smart money, weren't you? I thought I felt as dumb as everybody else in these markets. So how they actually come up with this distinction, what is smart money, what is dumb money, I can't really tell you. What you see in front of you here is obviously that dumb money, and they call the retailers who sometimes get it more right than the institutions, are being long for a while now and have reached elevated peaks again. And the so-called smart money is unwinding their positions at a dramatic rate in here. I have done the smart money thing as well on a different level. As I just said, I scalped my gamma on the straddle position I had in there. I'm expecting also slightly weaker markets, at least at the moment, for the next week. You can't really think any much longer on the shorter term trades, but I found that really interesting. What's your take on the smart money, dumb money approach I just described? Did you feel like you were the smart guys on the floor, or were you fighting with the same weapons provided to everybody else?
Well, you see, the thing about smart money and dumb money is that the smart money on this chart is basically short since October. And, you know, if you look, smart money is short since 4,000, okay, on the S&P.
Yeah.
We're 10% higher. And, you know, the problem for smart money now is they better be frigging right? Because there's, you know, that's it. You don't get too much more than that. There's only so much a fund can possibly take where you say, and that's why timing is so critical. You can be as smart as you want. You know, like the rest of these subscription services where they tell everyone to get out of the low. And now these guys are out of the low. So they better be bloody right is all I can say for them, because you know, they don't have flexibility. And that's why I say it's so important to keep people on the road so that when you want to stop the car, you can do so like you've done on scalping or gamma. You do that at a reasonable level rather than, being forced to put on a trade. And so, smart is not as smart as it used to be, is all I can say.
Yeah, that's why I praise the retailer here a little bit, because this chart, what does it tell you? You're absolutely right. Yeah. Since October last year, the short positions are building up and people don't believe that anything positive could happen in the markets. Hey, and we go from strength to strength. Now we have the first 2 quarters behind us. The performance of these guys must not be the best if they haven't been invested in NVIDIA for whatever reason, or Facebook or Google or Amazon or Tesla. That could actually be a very, let me call it, hilarious scenario. If they have to eat into the market, the retailers keep on buying anyway, and we could come into this complete, nobody understands it, but hey, here we are. We have new all-time highs in the market.
Yeah, I mean, it's clear, as I said to you, that the elastic band is bloody stretched right now. But if you're part of the smart guys who are not in the market or short of the market, you go to bed with a prayer beforehand, and hope that next day is when you see some retracements.
Yeah, so we have good and bad points. We have the move volatility going up again. We have seen equity volatility slightly recovering. The market is in a bit of a sideways trend, and what's lurking around the corner is this correlations seem to be running all in the same direction. The things you mentioned, the dollar, we expected to happen, did not happen. So I would be a little bit cautious at the moment. And the last scenario I pointed out is just, I find that intellectually very stimulating, that the so-called smart money got it completely wrong this time, and that the retailers, always being told off as being, well, the back holders, have got it right this year, without any doubt.
Yeah, and the power to technical analysis. I know you don't like technical analysis per se, but when I've been talking the dollar down, all the way down, and again at 103, and here and then I looked at this liquidity, and maybe I'm going to get wrong there, and then I saw the dollar go down. I thought, damn it, you are right. And I look at the yen as well. I mean, because again, the yen shouldn't be where it is, given where 10-year yields are, and given what's going on. And again, it's right, it's turning, and it's what I would expect to happen in that sort of bigger picture view.
Nick, they're starting to play the trumpets outside my window. I want to give you the last word, because you always remember the questions you have been asked and you want to answer. Last word to Nick.
I can't remember the last question that wasn't getting answered.
There was a question.
It was a book question. You can answer
exactly.
that one.
Do we have recommendations for books in German about, well, the economic cycle? By Ray Dalio. It's one of the best books out there. The guy has done a lot of research, and you can have it in the German translation as well. It gives you a very good understanding how cycles on a longer basis work. I really think that's one of the great books. You mentioned one to me earlier in the pre-show about economies.
Yeah, I mean, I think one of the smarter people out there is Michael Howell, and he did write a book on capital wars, and he is the expert on liquidity. He's been doing it since the 80s at Salomon Brothers for his boss at the time. And he is, I don't care what anyone else shows you on liquidity. If you have a question on it, you go to him and read his book, Capital Wars. I put it as well. Clever guy.
Excellent. Great. So thank you very much, Nick. That was enlightening again. Thank you for being out so early today with me. Well, you're an early bird anyway. I would have enjoyed having an eye in. But the band starts playing, so the music is never stopping. And I hope I will see you all next week, Sunday again, this time without disturbance. And I will be a bit better prepared mindset-wise than today. Thank you very much. Thank you very much, Nick. It was a pleasure as always. Bye-bye.
See you. Bye-bye.